Hello, I'm Alan Gelder, VP of Refining, Chemicals and Oil Markets for Wood Mackenzie. My presentation here today is to take you through the outlook for oil demand recovery, the implications that has for refinery margins, refinery utilisation. It will lead us to some conclusions. The first conclusion, cost reduction is necessary, but it may not be sufficient for parts of the industry. There are, however, a number of strategically or structurally advantaged refining assets. We believe these should be the ones that are the focus for the decarbonisation investments. Hence the title, Downstream Decarbonisation, to focus on the few. So this is just giving you a very simple overview of Wood Mackenzie's oils and refining research offerings. We go from crude oil supply to product supply to analyse the profitability of individual refining assets over 50,000 barrels a day using our proprietary simulator Petroplan. What you can see on the bottom right is a new offering where REM Chemicals, where we look at the profitability of integrated refinery chemical sites, and not surprisingly, what the evidence we're building is that these are the structurally advantaged sites that should thrive during the energy transition. So, a bit of a look back, and it's a look back in horror, really, in just how poor the profitability of the global refining industry was in 2020 as a result of the pandemic. What we're showing is the gross refinery margin for our global composite aggregate, where we're reflecting the refinery margins across the regions of Asia, Europe and North America. What you can see in the dark blue line is that for a 10-12 week period across the summer of last year, the value of the products produced from the global refining system were equivalent to, and not really much more, than the cost of the crude. Refining margins have recovered as we went through the end of last year. No notable uptick in refining margins associated with the vaccines, so quite different to what we've seen for oil price. But the key thing is that the refining margins in 2020 are materially below those of the 5-year average and have only just crept into the low range that we saw towards the end of last year. So refining had a particularly horrible year in 2020, driven by low utilisation, demand collapse, and OPEC Plus's efforts to rebalance the oil market, which narrowed crude differentials, so eliminating a further source of refining advantage. So what's our outlook for 2020 and 2021? 2021, we're actually expecting global oil demand to recover quite strongly. So what we're showing on the chart on the left hand side is global oil demand relative to 2019, and you can see that oil demand fell across all major regions of the world, but actually there was a limited drop in China and India, but overall oil demand fell by almost 10 million barrels a day relative to 2019. 2021 and 2022 are also shown relative to 2019, but in 2021 we're expecting oil demand to grow by over 6 million barrels a day compared to 2020. We will see net growth relative to 2019 for China, India, the rest of Asia, but Europe, North America and the rest of the world, their oil demand is down relative to 2019 all through 2021 and 2022. It's only in 2023 does oil demand get back to 2019 levels. If we look at the chart on the right hand side, we're looking at the individual products. We're showing that as a percentage of their 2019 period, and what you can see is just how deeply jet fuel demand collapsed as mobility restrictions and international travel came to an end. We've got that recovering through 2021 and 2022, but it's not until end of 2023, 2024 do we think jet fuel demand is back to 2019 levels. For gasoline and diesel, we think at the end of this year they will be broadly at 2019 levels, and it'll be through 2022 that they show, at the end of 2022, they show some positive growth. What we're missing are petrochemical feedstocks. But what it's clear is demand for distillates has changed with the change in demand for jet fuel, but road transport fuels will have largely recovered. If we look at refining margins, here we're taking some European refinery reference configurations. So for Northwest Europe, Brent FCC on the left, you can see for large parts of the summer of last year, the gross margin was negative. So even before fixed and variable costs, the value of the products didn't cover the cost of the crude. What we're expecting is for 2021, refining margins recover. They continue to recover through the summer as mobility restrictions are eased, people return to driving and travel and get close to that dotted 5-year range. We have the same aspect for the FCC configuration processing Urals in the Med. Recovery as we go through the year and getting close to the 5-year range. However, 2022, we've still got oil demand growth, but actually our forecast margin still remains below that 5-year average in both regions. That's showing actually what we're getting into next around the increase in refining capacity. So 2019, European refining was already in difficulties. Almost 40% of the sites were cash negative on an annual basis. What we've gone through the pandemic situation would have deteriorated dramatically. We've got demand recovery, as we talked about. However, what we are experiencing is demand growth is delayed at least 3 years, but capacity additions are only delayed by a few months. So even though we've had 2 million barrels a day of capacity declared to be being closed or permanently closed, when we look at the chart on the right hand side, we look at global refinery utilization, our outlook, we get a strong bounce back from the lows of 2020, but then we hit a plateau, and that plateau is below what we've seen this century. You actually have to go back to the 1980s. And to put that into context, what the European industry went through a period of rationalisation in the period 2011, 12, 13 and 14 as a result of its low utilisation. We're not expecting utilisations to get back to those levels, which means the threat of capacity rationalisation in Europe and other regions remains quite strong. So we think the recent closure announcements in Finland, Portugal, France, Australia, they will not be the last. This is something that we published last summer, highlighting those sites that we feel to be at risk of closure. And this risk of closure is over the effectively next 3 to 4 years. What you can see is that there have been announcements around a number of those sites already. Total Grand Prix is going to a biorefinery. Eni is looking at the same for Livorno. Gunvor at Rotterdam and Antwerp has already announced closures. Grangemouth has shut a CDU unit. We think BP Rotterdam could be a particular risk in the next few years. The other important aspect to note is this is not solely restricted to Europe. If we look at Asia, outside China, we think that a significant number of sites in Japan are at threat of closure. We've already seen 2 sites in Australia announce their closure. We think there are sites in Malaysia, Pakistan also at risk. For the US, we think a further 400 KBD is at risk of closure, in addition to the amount of conversions to biodiesel that have already been announced. So the threat of closure over the next few years is very, very real. But what we highlighted and what we discovered as we've gone through our refinery chemicals analysis on sites is that those large integrated refinery chemical sites are structurally advantaged. So what we're showing on the chart on the left hand side again is our assessment of their earnings in 2019, and we've just differentiated between those that are integrated refinery chemical sites and those that are standalone refineries. What's very clear is the integrated refinery chemical sites are in the first and second quartile of performance. It's the standalone refineries that are weakest. There are one or two integrated sites that are in that fourth quartile, but those are primarily integrated with aromatics, which if I take you to the chart on the right hand side, a couple of key messages there is that broadly, as the proportion of petrochemicals increases, the uplift through integration increases. However, it does very much vary by value chain, and those that are heavily integrated with aromatics are challenged by the oversupply of PX that was produced from significant capacity additions that came on in China recently. But our broad thesis, and we think this remains, is that significant petrochemical integration is a structural advantage to European refining assets. And how does it fit in with ESG and decarbonisation? This is a very simple chart. And what we're showing is the carbon intensity, so the tons of carbon dioxide emissions per 1,000 barrels of oil processed against the site earnings. And this is refining only. Where do you want your site to be? You want it to be in the target quadrant. You want it to be generating cash and relatively low emissions. If it's generating significant cash but emissions are high, that gives quite a clear message of emissions reduction through efficiency, green hydrogen deployment. If you've got a site that's in the bottom left, relatively low carbon intensity but weak margin, is that a potential to invest to upgrade that to improve its profitability? The challenge is the sites that are in the top left. Those sites have weak margins and high carbon intensity. Are they something the owner should divest, or should they be closed? Because the impact, it requires significant investment to move them into a different quartile where their profitability and their environmental credentials could be materially enhanced. So we're expecting this type of analysis to play out with portfolio rationalization and portfolio assessment by the integrated oil majors. So if we're going to conclude, what can we say? Well, ESG is really driving a focus on cost reduction and decarbonisation. We expect that to remain. We think further cost reduction is necessary but may not be sufficient. And that's really because even though mobility restrictions will be eased, oil demand will grow, refinery utilisation will remain low, and the threat of rationalisation will remain. We firmly believe large integrated refinery petrochemical configurations are the most resilient to the energy transition. ESG requirements will focus corporates on portfolio rationalisation that focus on such structurally advantaged assets. Shell is a prime example of this activity over the recent months. And for us, that highlights that the decarbonisation efforts, which are around furnace electrification, green hydrogen production, biofuels, chemical recycling, are to be focused on those structurally advantaged sites to deliver value associated with that investment. With that, I'd like to thank you for your time and invite you to provide me with questions that hopefully I'll be able to address. Thank you very much.
Thank you very much, Alan. That was a very insightful presentation. I think it sort of hits home the reality of how difficult it's been, not just during the pandemic for refineries, but also pre-pandemic, which I didn't realize how severe it was probably beforehand. But oh my God, I mean, it begs the question, which I would like to actually start with you. Did any refiners do well during the pandemic?
There was a few, actually, and actually they tended to be in China. They were some very significant investments that were made that actually got commissioned towards the end of 2019. And in 2020, they generated huge amounts of cash, but they were huge refineries, 400,000 barrels a day, and heavily integrated with petrochemicals, Hengli and Rongshan. So for those who are interested, Hengli reported their Q1 to Q3 earnings, and they made over $1.4 billion. So they were generating significant amounts of cash, while most of the
Mm,
refining industry was losing a lot of money. It all comes down to that petrochemical integration that they had.
yeah. In your view, or in Wood Mackenzie's view, when I know it's probably a generic question, but when does oil demand peak?
We're, we're of the view that oil demand continues to grow. We don't see oil demand having peaked in 2019. We're adding
Mm,
1.9 billion people to the world's population. GDP is doubling by 2050, and a lot of sources of mobility will be fossil fuel based. So last
mm,
year, 2020, electric vehicle sales were only 3% of global car sales. So we think oil demand continues to grow, maybe gets up to 109 million barrels a day, but hits a broad plateau in sort of the mid to late 2030s and then starts to fall. So that's not good in terms of
mm.
overall emission, yeah, and yeah, global climate change.
Yeah, I mean, leading on to that point, what needs to happen, obviously, to be consistent with a 2-degree temperature rise? What could this mean, obviously, to refining and the industry? Because, as we've seen throughout this event and what you presented, decarbonisation is putting a lot of pressure now on how refineries are going to be operating going forward. So, what do you see that? What's your view on that?
We think there needs to be a huge and significant change in policy,
Mm,
which forces the adoption of low carbon technology, and that needs to be in the transportation sector. So if you look at Wood Mackenzie has alternative outlooks on accelerated energy transition. The IEA has got its sustainable development scenario. All of those have significant drops in oil demand growth. They
mm,
tend to have some petrochemical growth to a various degree, but what that means is effectively the refining industry needs to pivot towards petrochemicals, but also get smaller. So if the industry is going to invest to adapt, it actually needs to be profitable to do that. And that we think is
mm.
the industry really needs to high grade, and there'll be some difficult choices around a number of sites that are not viable over the long term.